All right. Well, want to thank you all again for coming to FXIC. My name is Greg Berman, and I manage the M&A Advisory Services Group at Shift Forex. Really looking forward to our discussion on M&A today. As you know, M&A is one of the hottest topics in the industry. As you're well aware, M&A has been a key feature of the space over the past several years, with major acquisitions by a multitude of players across a variety of segments of the industry. Changes in regulations have been a key driver, as has the increasing competitiveness of the market and need to seek new clients via account acquisition or other channels. We have also seen a dramatic increase in the number of technology providers servicing the industry, which has also seen a lot of activity itself. So very excited for our panel today. First, we have Drew Niv, CEO of FXCM. FXCM has been one of the key players in the M&A space with a number of acquisitions over the past several years. We also have Bruce Cameron, the CEO of Berkshire Capital. Berkshire is a specialist investment bank in the securities and investment management industries. Berkshire also advised on Refco's sale to Lehman Brothers in 2007, and as you heard at the opening remarks, has recently expanded their FX M&A team. We have Chris Sugden, managing partner of Edison Ventures, and he leads their largest industry segment in financial technology and services. Edison were venture investors in Gain Capital pre-IPO and majority owner of Trader Tools. We also have Solomon Sredny, CEO of TradeStation. TradeStation is a brokerage offering trading across a variety of products, including FX futures, options, and equities. TradeStation was acquired by the Monex Group for a very large figure, and they've also completed their own M&A activity in the retail space. Finally, we have James Fisher, a partner at Drinker Biddle in the firm's corporate and securities practice, and his practice includes financial services firms, and he advises on M&A transactions as well as venture capital financings. So the first question I wanted to address to the panel is that the advance of global capital markets and ability to freely transfer money across borders has led to the ability to readily conduct trading business with customers virtually anywhere on the planet. With the exception of the U.S., a number of FX and CFD brokers accept customers from jurisdictions where they're not licensed. In many instances, they offer leverage and other trading capabilities that are beyond what is allowed by law in the customer's home countries. So when you guys are looking at an acquisition, how much does this factor impact the opportunity and how you value that particular acquisition? Start with Drew.
I mean, for us, that's pretty much in the deal killer 90% of the time, I would say. I mean, unfortunately, is that the second we take over a company, we have to impose our standards on that firm. And for example, if you're a US company or today even a British company, and we're both, you have to, so AML rules apply to all your customers. US AML rules apply to all your customers no matter where they're based. So it's just one of those things that, that's usually a deal killer for us, and it's, there's unfortunately no way around, that, and that's, you see a lot of companies that are thriving as standalone and they're doing really well, and they say, well, I'm worth all this money, and I go to the guy and I look at, 30% of his book is from clients that I have to throw out, another 30% of clients that wouldn't trade with me because he's offering them things that I won't be able to because of regs, and that pretty much kills it.
Okay, great. Bruce?
I would agree with that. I think a lot of times when people are looking at these businesses, they'll try to figure out what portion of the business can fit with theirs, and at the very least, if they're even willing to go forward, they're going to look at what sort of adjustments they have to make to either fit it into their own constructs, or if they're thinking that they're going to continue to expand, where they're going to end up going over time. And so given that the larger markets have tended to put in restrictions and regulations, I think most people are going to be looking at how they conform with those going forward.
Chris?
Yeah, I don't think you're going to get much debate on the panel on this one, particularly similar from Gain board member, shareholder hat. I have the same view that Drew does, and so does our board, from the perspective of you must comply, you have no choice. I think from a venture investor perspective or private equity investor perspective, it's really not all that different, because at the end of the day, you're trying to figure out what part of the business is going to scale, and you're also looking at an exit strategy eventually. So if the guys you're going to sell to are an FXCM or a gain, you're sort of stuck with the rules, right? And frankly, the same goes for the larger public companies such as an IG in the UK. They're going to have the same answer. So there really isn't a lot of debate. And this really goes to, do I have a nice business I can make money, a current income, a lifestyle business, and get away with it, in quotes, versus I want to scale and be part of something larger.
You have a different view on that?
The horse is pretty dead, so I'll keep it short. But bottom line is you can't get around regulation. You can't get around regulators. You don't want to. So if it's an issue, it's non-negotiable and tough to get through.
Okay. All right. So there are a number of potential strategic buyers for an FX and CFD broker, including banks, other brokers with minimal FX operations like commodities brokers, financial services companies. In addition, there's sort of the universe of financial buyers like private equity and venture capital funds. Curious, what are the major differences in how strategic buyers look at potential acquisitions relative to financial buyers, and what sort of other considerations should a seller be looking at when they're looking at these two different groups of buyers? Start with Solomon's son.
Yeah, so good topic. I think from the buyer's perspective, if you're a strategic buyer and you're in the business, normally you're going to be able to extract a lot of synergies, you hope, out of the transaction. And the whole idea is how can you value the asset, grow the asset, and realize some synergies. I think when you're in private equity, you're looking for something to leverage, something maybe you could put together with another asset and really look and figure it out. Do you have something that needs capital, that can use the contacts and everything private equity brings to the table to make it successful? I think from the seller's perspective, obviously, if you're getting bought by private equity, you're probably going to stay there, at least for a period of time, and you avoid some of the social issues with merging with a strategic partner. I think obviously when you merge with a strategic partner, you always have the social issues. I was at Harvard in January, and part of the topic was this, and the golden nugget I took that was very interesting is for sellers that are interested in high payouts, you probably ought to go with private equity. For sellers that are focused on control and wanting whatever they want to do with a firm, they're probably better off with the different partners. So pluses and minuses, and obviously every partner is different, but a lot of considerations depending on the partner.
Yeah, let me just add one thing in terms of the PE space. From what we see from a legal perspective, I think it depends on whether or not the PE play is to increase an existing platform or this is the first foray into that platform. So from a people perspective, are we going to keep and do we need to keep all of the people? Is that important to the seller? Depends largely on what the PE firm is looking to do, what it has done in the past with respect to its existing platform. Strategics always, of course, have this notion that there's maybe potentially one additional dollar or two, and there's sort of this notion out there that we hear from sellers that they think, I'm not sure it's necessarily based in fact, but that strategics have a few more bucks to throw around than PE firms. We don't really see that too often. We see different structures a lot of times from PE firms to strategics in terms of the way that they make their payouts in terms of deal structure, potentially earnouts and contingent payments and things along those lines. But from the seller's perspective, we always encourage people to look around as much as they can to get as many offers and opportunities as they can before they make choices for a lot of reasons, especially if you're a public company. Obviously, you've got fiduciary obligations to your holders, to your shareholders, to make sure you're getting the best and the most efficient deal you can.
I think from a seller's perspective, in the world, maybe 2/3 of our deals are in sort of maybe pure technology companies versus financial technology or trading companies. And in that world, the financial buyers are as active or more active than the strategics right now. Literally, we have a couple of companies going through processes where it's 80% financial term sheets and 20% strategics, which has been surprising to us. This is the last 3 or 4 months of activity. In this world, when I wear my gain hat or I look at a company that's got a balance sheet it needs to consider, and we think about the way your balance sheet may or may not be encumbered with regulatory capital, the financial buyer's in a lot tougher spot to offer the same kind of deal a strategic can. And so if you're a seller, now it all depends, are you as a business, are you more just an IB, if you will, and just a sales engine, or are you actually a full-on broker where you've got the regulatory capital issues? So I tend to see this market itself, the strategics can provide a lot more upside on the price. And at the same time, the synergy comment, as we sit again as a gain board member, we're constantly poking away at what costs come out because you're only doing this deal if there truly is cost synergies. There is a question of brand, where customers are comfortable on brand A versus brand B. That sort of, now you're going to manage two brands. And actually Drew should comment, because he's dealt with this a lot in terms of that sort of doing some M&A that's worked for his firm. But when I look at it at Gain, the ability to leverage the regulatory balance sheet is an asset that the financial guys can't bring to the table. So by definition, there's some money being unlocked that should benefit the seller if done right.
Yeah, I tend to think that the strategics typically have the ability to pay more if there's a real reason for them to do that. I think there's a couple different categories of transactions where there's a strategic player. There's one where it's really an integration of the business, and they may or may not feel compelled to pay as much, particularly when there have been some distressed sales, as there have been. But if they're trying to accomplish something and there's a real reason why that particular business they're pursuing fits a strategic goal, it helps them get into a marketplace or bring some technology or a client base that's important to them, then it fits into a broader goal, and so they're willing to pay, in our experience, more often than a financial buyer. Again, it really depends on what the structure is. A lot of times with the private equity, they have a very sharp pencil about what the pricing is and what their returns are going to be, and so you occasionally get strategics where the sharp pencil is not as focused on the numbers, and it's more on the objective they're trying to accomplish. So I agree. I think you want to try and go to as a broad a group as you can, but you're trying to get a sense of where the marketplace is right then. And the strategics haven't been as active, but if they are, it's an attractive way to get a higher price.
Drew? Yeah, I think as Chris was saying before, because if the private equity firm needs an exit, essentially looking at the benchmarks of how he would get that exit. So he has to price it that he's going to be able to resell it. Right? And I think that given that the exit has been pretty dismal, and you can see, like, I think 2 weeks ago, after 2 years, we finally reached our IPO price, back. Right, so I think it went 10 cents or something above it, and it's and it was partially bad timing, right? We kind of went public right into a turn down in volatility, and partially, it's an industry regulatory issues, but that impacts what people will be able to pay, and I think there is in this industry, I would struggle to say, we have not had one time, and we've probably looked at 40 deals in the last 2 years, did 4. Not one time did we compete with a financial buyer. It was always strategic buyers. And I would say half the time, we had no competition. And it's a question of, if people think that there is, it's not a matter of choice in our industry as much as it's a matter of, do you want to sell or not? And the market price is however many buyers there are, to do it. And I don't think that there is, financially, I don't see a lot of people. Financial buyers, I don't think there's a lot in our space. If I get to 25, maybe, so you got to cross your fingers, I get to 25, and, it'll be lots of financial buyers. And I think that, but until that happens, that's not going to happen.
Okay, so basically everyone should buy a lot of FXCM stock.
Yes.
Is what Drew is saying.
Yes. I'm not inferring anything. I'm saying that.
So sort of off, related to that, at the, in terms of talking about an exit strategy, at the Forex Magnate Summit back in November, you were less than enthusiastic about the idea of IPO, making sense for Forex brokers. And I'm just curious, based on your recent gains in your stock prices, your view had changed in that at all?
My view is very simple. It's is that public investors are the best fair weather friends a person can have, and obviously, when you do well, they love you, and when you don't, they're unforgiving. And so it's just purely a question of the only reason to do it is for credibility and for currency, right? And so if you have, if you're doing well, the currency inflates, and you can use it, to buy things. If you're not, it's a terrible place to be in. So I think it's a question of, and it just adds enormous amount of costs, an enormous amount, millions of dollars of cost, right? So with, for all of those who are based in, Western jurisdictions who are already facing enormous amount of costs from regulators, adding the public entity to it just raises it that much more and makes it that much harder. It's been worth it, I would say, to us. I'm not, I'm not on the record to say that it's been worth it to us because we've managed through the downturn, but, I would have probably, Chris would probably have a different answer.
Yeah, I think, look, the gain stock's still below the IPO price, but the issue is broader, and that is, and I know that FXCM and IG struggle with this issue too. How do you tell the analyst the story? How do you model volatility? You can't, this isn't darts as easily said as it is in some other industries. The agency versus market making question hangs over all these businesses, and am I or aren't I? At the end of the day, everyone's making a market in some way, shape, or form, but that's not really the issue. The issue is, can the analysts actually get their models right? And I think some have done a better job in this educating the marketplace than others. But at the end of the day, the market's paying for certainty. And by nature, the FX business is not a certainty kind of model. And so what does GAIN do? It goes out and says, we're going to diversify our revenue base, right? We're going to offer futures, we're going to offer institutional. You're going to start to diversify. So I would say a pure play FX business going public right now makes little sense. A business that's got some more diversity in its revenue stream and an ability to really sort of say to the market, here's how to think about modeling our business, then you've got a shot. But I'd actually, the bigger one of all this is the headache of compliance. It is an unbelievable burden because you're not just dealing with now the CFTC, you're dealing with the SEC. And then by extension, you're dealing with all the different entities around the world that sort of now have a deeper dive into your books and records. So all those rules that you want to comply with, think about having to comply to a letter of the law with them by being a public company. So I think the cost is, as Drew said, millions of dollars. And I do question whether a pure play, it really makes sense right now.
Go ahead. We talk to our clients all the time about what the cost will be from a legal perspective and an accounting perspective if they take their company public. And we tell them conservatively to figure on $1.5 million to $2 million in increases for things that you have to do, period. Between GAAP compliance, between SEC compliance, and if you take that number and then you say, I'm going to be in the UK and I'm going to be in Germany, I'm going to be here, it's not going to multiply each time, but you're certainly adding to that. You can get to $3 million of increased costs without blinking an eye. And oftentimes at the end of the year, people will come back to us and say, why did my legal costs increase by 400% last year? And we say, well, because you now just made 8 filings that you never had to do before. So it's certainly it can be a daunting task, especially the first time around. And we always do encourage people that are going to go public to look at who they have around them to make sure that there's somebody in that space that has some experience with it, interacting with public company regulators, because it is much different than being in the private space.
The one issue that nobody mentioned that I think it's important is, for the most part, most of our businesses in FX today are retail businesses. And I think in the U.S., the retail FX the retail FX world is a diminishing one. And I think that you have U.S. investors trying to understand foreign FX traders. And I think that adds a complexity where people don't get the business, people don't understand who we're going after, why they exist. And it's a little foreign, not to use any puns, for most folks, and tough to sort of digest, especially when they're financial experts. I think that creates additional complexity to in effect, marketing and promoting an FX company in the U.S. equity markets.
I guess one of the questions that I have is that there's certainly additional cost and there's the transparency, and all those things are problems, but it strikes me that this is an industry right now which is going through a fair amount of consolidation, and as painful as it may be, I'd rather be in your seat than a private firm. You've got the currency, you've got a way for people to find out about you, and I think a lot of the issues people have is understanding and believing whether some of these firms are legit. And so if this is an industry that's consolidating, I give you guys, GAIN and you guys a better shot than somebody who's private. Doesn't mean that you'll succeed and they won't, but it gives you, I think, you have a head start.
Yeah, no, I definitely agree. we're lucky that we are public in this environment, right? Because as private, you wouldn't have been able to get any money out or do anything, right? As even an owner of a firm trying to monetize a stake today as a private company is going to be excruciatingly difficult. And so definitely that. But if you're going public to grow the business, you better be big and you better be diversified. You better be a lot more stable, and don't do it here. Because you will, like Solomon said, you will have American investors in Oregon, right? You have like $40 billion in their funds asking you, who trades foreign exchange? Why do people do that? I don't want to buy this. And that was half my meetings during the IPO, and so, and these were like big brand name, mutual funds. And it's not, and that's a big issue.
Well, and the U.S. regulatory environment has taken and pushed, this businesses out of here, right? So you add to that fact. So actually going public on either the U.S. major exchanges, I'll add to, if a retail pure play is almost a non-starter, I'd say doing that in the U.S. is just plain stupid, when you think about what your customer base is, right? And you look what, I know these guys have done, what we've done at Gain, you've got to diversify. And it's not just the leverage issue, it is the customer acquisition issue, it is the market understanding issue. For some reason, you can open a casino on every street corner, but FX has got a bad name, in terms of the way the regulators look at it. So go figure that one out.
Yeah.
We came from a different place, right? We were first an equities firm, then we added futures, and then we added Forex. And I can tell you, as a public company, people and we were dealing with an installed shareholder base already, but explaining that business, people are it's tough for them to buy.
Mm-hmm. That's a great lead into my next question, which is, obviously the FX industry has seen a dramatic growth in technology offerings. You have social trading platforms, a lot of other offerings around risk management, binary options. We've seen investments in things like currency, Leverate, Boston Technologies. And so I'm curious, where can we expect to see future M&A activity and, outside of the FX brokerages in this space? Start with Drew.
If anybody survives the bank run that is impending in Cyprus, there's probably going to be a lot of, M&A there. That would be my first guess. And although if anybody survives, I think is a big if. And but I think a lot of the, especially if customers are going to lose a lot of money, in a place like Cyprus, there's going to be the brokers who have a credibility gap because they're in a not really in a credible jurisdiction, and if you will, sort of in a pretend jurisdiction. I think that's going to be the first place. I think technology is a place where some M&A can happen. The problem for a broker buying technology, for example, is our valuation as a public company is probably half that or a third of a technology company from a PE ratio. So if a guy who has technology saying, well, if I compare myself to a tech firm, you should be valuing me at 25 times earnings. And in my wildest dreams, I don't think I will ever get to be valued at 25 times earnings. So if I buy him at 25 times earnings, that my stock goes down, right? So that's just never going to happen. So I think that, if we were going to buy a tech company, we would have to pay broker valuations for it. And it's a question whether that is worth it to think. So I don't know if there's a lot of, I'm not sure if there's going to be a lot of people like us doing a lot of tech deals because of that.
If you expand the notion of what M&A means and you take it and move it into the VC space or the PE space or even the joint venture space, you can see a lot of potential deals that aren't traditional M&A deals. You can see a lot of partnership or joint venture kind of relationships that allow sort of tech companies to get into a liquidity position where they can take some money off the table, but also not actually sell their company. So we are seeing a lot of alternative structures to your traditional M&A sort of relationships and your traditional deals for exactly that reason, the valuation gaps. And a lot of times we're also seeing, tech companies that really want to to move out of ownership, and they don't have many options in some respects if they really want to kind of move into the space. So they're willing to consider alternative kinds of payouts, earnouts and contingent payments in terms of, we'll pay you this, but you've got to sort of demonstrate that what your technology says it will do, and do it for a sustained period of time, several years. Doesn't happen a lot, but it's happening. And we're seeing a lot of sort of conversation in the deal world around software and technology that deals with the increased regulatory environment, software that is trying to make compliance easier, which is certainly a challenging thing to do in an ever-changing environment. You develop your software and then 30 seconds later, you've got to change it because the regulatory environment has changed.
I think fundamentally there's no reason you couldn't do a contract with a technology company that would lead you to the need to have an acquisition. So ultimately, there's a lot of things you can do by way of contracts. You don't have to buy the cow, you can just rent the milk. Because of the issues that Drew was mentioning, I think it's pretty tough for a broker to buy a technology company. Having said that, I think everybody knows that we're for the most part a technology company, and about half of our employees are in the technology field, and we have two subs, TradeStation Technologies and TradeStation Securities, and we're actually now doing all the technology for Japan in Monarch's group. I think the tough issue is that I see a lot of technology. I'm not convinced that I see a lot of technology that is phenomenal and can really move the needle. And for every technology idea, I see 3 or 4 competitors within weeks. I mean, nobody seems to have an edge, and it's pretty much the same mousetrap, and with just different parts to it. I think the challenge as brokers is how do we differentiate ourselves in the marketplace? How do we attract clients? And I think that my suspicion is more and more that will happen by way of contracts instead of by way of acquisition, because it's just, one, it's tough to place the bet, and two, it's tough to pay the price.
I think when I think about my Edison hat, my day job, and we look at technology companies, generally that's what we do. We only have a few sort of balance sheet or trading type businesses. What Drew said about value is true, but we also know about predictability, that recurring revenue piece. I'd rather be an arms dealer to this space than a broker in the current environment. And I actually, having been down, Sal and I ran each other last week at the Future Industry Association meeting, and what you hear is, we think in our business, risk and compliance and risk management is more about kind of back office and tending to not getting in trouble. Traders tend to think about risk management as the next algo strategy to take advantage of, risk on, risk off, kind of in their own portfolio. And I see some technology companies that are pretty interesting and go cross-asset. And the thing about FX, in my opinion, is it's actually still pretty nascent. When you sort of look at what happened in equities over the last kind of 10 or 12 years, we were an investor in a company called Edge Trade that sold at night, and that was a technology company, got paid. It got acquired more of a technology kind of multiple, but Knight grew that from a nice business to a very large business because it took that technology and put it through its distribution channel. So I'm not so sure all is lost to selling to brokers who have big businesses if they can see the future. The issue is, of course, dealing with the last couple of years of the doldrums in stock price and the market, and all those things kind of bring all sentiment down. So it's sort of, you're sort of glass half empty when someone says, I got a cool mousetrap that can do it better. But I think when you look at algos, when you look at some stuff in the back office relative to risk management, when you look at what this trade's really costing me, could I have had a better P&L performance if I had better risk management tools, if I had a better algo, if I had an option on that FX trade? There are all kinds of things I think are happening right now to the FX space that are probably 3 and 4 years behind, where maybe even 5, where equities are.
I guess the thing that I look at, and probably because of my bias, is whether some of the CTAs or things like that may link up in some way, shape, or form with this industry more. The industry is trying to think more about how it generates returns on the investment side. Or some of these people are going to say there's an information flow or an activity flow here that is useful for them, and some of the things they're trying to do is they're trying to find edges in the market, and I can see some of the CTAs trying to find a way to back into or acquire into this industry as well.
So In terms of, when someone's looking at an acquisition, there's clearly a number of ways to value an FX broker. You can look at discounted cash flow models. You can compare it to publicly traded companies using earnings or other multiples. You can certainly do, comparable companies analysis. Obviously, there's a lot of factors within this, and I'm curious what sort of methodologies and metrics you typically use when you're looking at acquisitions. We'll start with James. Maybe you can address from sort of a legal side.
Sure. I think that we see from the other side of the table, so to speak, how the investment bankers go about doing this, and they look at it, I think, all of the ways that you mentioned, but then I think they begin to chip away at those methodologies and say, what can we look at that are not sort of the traditional methods? I think they look at growth rates, and these guys will tell me if I'm wrong about this, but growth rates, sustainability, year-over-year performance and things, and they try to look at a diversified customer base as opposed to a lack of diversity, and look at, not purely from a financial perspective, but what can you read either into or out of the financial models, and then they adjust their purchase price based upon that. The other thing is as they go through their process, they might start with certain methodologies, and their diligence might tell them from a financial perspective that this is a solid valuation. We as counsel might come in and say, well, you might want to think about this sort of set of liabilities that are pure legal liabilities, and how does that play into your valuation? And again, it potentially chips away, or the lack thereof, and maybe that allows you to pay a premium on what your valuation tells you.
I think investment bankers go through all kinds of gyrations so that when their firm gets sued after they buy or sell, because everybody gets sued, it's America, they can explain exactly what happened. But I'm a pretty simple guy, and I think all the valuations basically get back to ROI and cash flow. And basically, I think whether it's a PE firm or strategic, it's pretty straightforward. What are you paying for it? What are you going to realize in synergies? How likely are they to come? What kind of cash flow are you going to realize? And make sure the ROI is there. So I think all methods, in my opinion, I think when you have a business hat on, gets back to what is my ROI? And private equity side, obviously you get an ROI. You have to think about when you exit, what is that going to do, and how much can you grow it? But again, back to synergies, back to cash flow, and to me, it's all about the ROI.
You asked a specific broker question. I think it's what Drew said earlier. You look at your own PE multiple or EBITDA multiple, and you say, this is the fact of life, and I got to explain to shareholders why I paid more, if I in fact paid more than my multiple. I think from my sort of my venture hat or growth equity hat, there's a little bit of art, or even more art than science, in that valuation, right? Because you're trying to figure out scale. You're trying to think what you're going to do with my money. You're trying to think about ways, and now I'm thinking about technology companies as much as I'm thinking about brokers here. We think in terms of revenue multiples if you're high growth. If you're not high growth, then you do start to go, wait a minute, this is all about the PE. So that top line's driving hard. Then you're thinking about a revenue multiple being more indicative. If it's not, then you got to go DCF. You got to go PE multiple. But I think when you sort of look at it as a stage of business, the smaller you are, the more art you can apply, and you have to apply. Whereas the larger you get, the more you're going to be held to what's that PE multiple.
Mm-hmm.
I think when you go through this, all the methodologies have been espoused are true. What you're ultimately trying to look at is how does this fit into what you're trying to accomplish, and then how consistent with the past or do you think the future is going to be for that particular business? And so it goes back to Drew's point at the beginning. If you think you've got to get rid of 30% of the business and restructure another 40%, then the numbers from the past aren't terribly relevant. So, we try to look at, does the business stand up to scrutiny? Are there things in there that you're going to have to adjust? Are there expenses that need to go in there that aren't in there, or are there things that you can save? And so you're trying to get a very close analysis of that business. You look at sort of comparables to get a sense of whether maybe you're missing something, I suppose, as a point of reference. You look at the public firms the best you can, but ultimately what you're trying to go through is to understand what you think the business is going to do going forward, and that you're going to get the return that you need, and that goes to whatever your requirements are for your business. But if you're not doing it for that, then you have to wonder why you're doing it.
Yeah, I think for the only thing I would add, and I agree with a lot of what's been said, it's just that there's sort of two other things that are very important. One is the more jurisdictions a person is regulated at, the more regulatory surprises are going to spring up. So there is, if you're regulated in 4 jurisdictions, you have 4 audits a year and 4 potential places where liability could come from that you can't see in the balance sheet or the cash flows right now. And now is, makes more cautious, especially that every jurisdiction today and all the big ones are changing and changing, all their rules and changing their benchmarks. So in what they considered to be standard last year is now completely illegal. And they, most governments feel that because they changed their mind on Tuesday, they can go back 3 years and say, well, now I think what you did 3 years ago wasn't right, even though we sort of blessed it last year. And I think that puts a whole new, layer of complexity to M&A. And I think the other complexity is the function of that. A lot of, and it's just a sad fact of a declining market, is a lot of the deals are essentially all about the cost synergies. All right, so it's just a question of when a broker buys another broker, the ideal attraction is the fact that you're going to sack the majority of the staff and the majority of the cost period of the people you are buying. That is just the way it works. And you wouldn't do it if the market was growing 30% a year, because you'd be growing 30% a year, and this is relatively useless to do M&A. But when the market's shrinking, that's how you grow, and that's the only way to keep it from, you're not firing your own people. So to keep that to a minimum, you want to go and buy somebody and fire their guys. And so part of the issue is, if you're going to go buy people, as I found out the hard way, in Japan, it is insanely difficult to fire people in Japan. You have to ask them to go, and they may say no, and then you have to convince them, and you can't really fire anyone. And in Europe, it's, a mosaic nightmare all on its own in every country. And that, I think, is preventing a lot of M&A from happening, because you take over a British company or a German company or something like that, then the majority of the value you're going to create from that, you can't create, right? And there is just that, and I think that's a big, where you're based and how easy it is to reorganize and what it is very important. And I think that in a lot of situations, it's just natural that, generally speaking, management is not fully honest with the employees of the firm as to the financial condition and what is going on in the industry or at the firm itself. So when we take over a company, all of a sudden we have to tell people that, this company was losing money and was on the verge of bankruptcy, and we sort of came in, so now we have to restructure. And people are like, what? We weren't losing money. Liquid lunches are good for business. And it was all the restructuring you have to do, that's a big consideration. And in the valuation, if we're buying a business that's hard to restructure, there's no way we'll pay more money for it, where a business that's easy to restructure is a business that, much easier to squeeze, money out of it. And that's just, the blunt, fact of life.
Okay, great. So I think we've got time for about one question from the audience. First, any questions?
I have a question for Salman. You said something interesting. You said that you have a situation where U.S. investors are trying to figure out how to market to foreign FX traders. And I'm wondering if you could just maybe highlight a difference between, what is the difference between U.S. FX traders and foreign FX traders in your mind?
So for the average American, they understand what buying one share of Microsoft means. They understand what buying one share of Google means and one share of Coca-Cola, and they've been doing it for a long time. They were told as kids by their dad, to average down, and it's become sort of part of what we all do as Americans, if we're good, patriotic Americans. On the future side, you sort of graduated from equities, and people don't they kind of understand what, if you get those barrels of oil or the pork belly or the delivery, they understand it's a contract and they understand it's a good. Americans, for the most part, are very introverted and American-looking. So a lot of this is my opinion, so please accept it for what it's worth, not much. What happens is, basically, Americans, we're going to rule the world for the next 1,000 years. The dollar is the only safe currency in the world. I mean, who would buy other currency? So for Americans in general, what I find, and I'm proud to be an American, please don't, I don't want anti-patriotic things coming out of me. But at the end of the day, they don't understand who, Drew said it, who trades foreign currency? I mean, who's crazy enough to trade foreign currency? So it's completely foreign. If you go out on Times Square and you ask 10 folks out there, what is the exchange rate between the US dollar and the euro? Probably 60% will ask you, what are you talking about? And the other 40% will say, I don't have a clue. Maybe you'll find one or two. If you go to Europe or you go to Asia and you ask anybody anywhere, what's the exchange rate between the euro dollar and the dollar, probably I'll bet you 6, 7 people will know what you're talking about and know what it is. It's just we as Americans, it is foreign. So the market in the U.S., and if anybody disagrees, is much smaller. All the growth is outside the U.S., and in general, it's very, very foreign. Does that answer your question?
I think the big, if you want to say that we saw 80 investors in their IPO roadshow in 2 weeks. Outside of New York City, no one knew what foreign exchange was. And this is like all brand name large funds, right? No one knew. We left the 30-mile radius in New York City. Nobody had a clue what was going on, right? It was pretty sad. And these are all multi-billion-dollar companies, right? Just when you're managing your money, note, please. We did a day in London, and we met 9 funds. 7 of the people of the funds we met, so of the fund managers we met in London, had an account at IG, right? And 2 had an account at FXIC already, right? So when they only put it together at the meeting that they were customers of ours, and they said they can trade FX because they're professional equity money managers, so they, they're not allowed to trade equities for their own account, but they're allowed to trade FX. So they knew how to do that, and we went to Frankfurt and Milan, and everybody knew what FX was, and some people had accounts at different places, whereas like I said here, nobody. And this is people who manage billions of dollars, right? And large amounts of the pension money in this country is invested in these people, and we live in a globalized world, and they have no idea in practice what it means, right? And I think that's that's what it is. If you're listing the company here, you're essentially, facing, although today, I can give you the names of 25 funds who understand FX volatility and have the CVIX on their Bloomberg screen and are following it and trading, gain in FXCM or whatever it is according to that, but there's only 25.
Great, thank you. Well, unfortunately, we are out of time for the panel, but I really wanted to thank the panel. Very interesting topic. And so I think we've got lunch after this. So yeah, I think somebody else will be coming up in a minute to give you the rest of the schedule here. Thank you.
Thanks.